Okay. By the way, if you'll notice the red lines and how many we have on this wall, by the way, they are recessions, depressions, or panics in the stock market. And you can see that the Cowles Index dropped 41% between 1873 and 1877 because of that recession. Oh, by the way, you'll see these blue names. These are the presidents of the United States. And Garfield and Arthur. Garfield was assassinated in 1881, and his vice president, Arthur, became the new president. And you can see that shortly thereafter, Grover Cleveland became president of the United States. And notice here, the Dow Jones Railroad Average came into existence in 1885. That was Dow's first average. And you say, well, why just railroads? Well, railroads was the biggest industry in the United States at the time. So it kind of makes sense that that's what he would start with.
Everything started
yes,
right here.
Yes, so the Dow averages actually start in 1885. And it was in 1970 with the organization that you and I are members of that went to the Wall Street Journal and said to them that the railroad average is getting dated. And we convinced them to change it to the Dow Jones Transportation Average. And now that average includes railroads, truckers, airlines, anything that moves in the United States. Again, look at all these recessions and depressions. This is before the Federal Reserve was created in 1913. And that's why they created the Federal Reserve, because we were having depressions and recessions almost every couple of years. And then, of course, look at the Dow Jones Industrial Average was created in 1896, a few years after the railroad average. And this is what Charles Dow wanted to create, an average that captured the industrials. The railroads move products, the industrials are the creators of products. And that, by the way, was the reason behind the Dow theory. They wanted to make sure the movers of products and the creators of products were going in the same direction. And then when they started to divert trends in technical analysis, that could be the early signs of a coming bear market. And of course, we have the presidents again. McKinley, unfortunately, was assassinated, and Teddy Roosevelt became president. In fact, it was under President Roosevelt, this was the progressive period in the United States. And that's when people were upset with the government, and they were upset with big business. And it was Roosevelt that did the trust busting. Standard Oil of Indiana was a big company that had to be broken down. It was too big. And interesting. It's history.
Yeah.
Yes. Yep. And as we go along, of course, Taft, Howard Taft, Ford's Model T came out. Look at that, 1908, Ford's Model T car. Federal Reserve System founded, as I said before, and as a result of all of these recessions.
Do you remember the first chairman, the Fed chairman that was?
Oh boy, I have it written down.
Okay.
I can get you the whole list of all of them, actually. I have it, but boy, you got me. Woodrow Wilson. By the way, notice the First World War. I had to rescale the Dow average to capture the decline, and the New York Stock Exchange was closed 4.5 months when the war started.
It's the only time that happened.
For that length of time. No, they've closed it down briefly. 9/11 was an example when they closed it down for about 5 days, 6 days. Yeah.
Wow.
By the way, look at the gold line. You see the gold line? How flat it is? It was in 1873 that they stabilized it, the gold standard, and it stayed at a price of $20.67 for 50 years.
Wow.
Silver started to fluctuate during the war, but gold stayed flat because it was the gold standard. And shortly after the war, starting in 1921, the roaring 20s, and the stock market literally exploded. It was up over 500% in 8 years, or almost 9 years. Can you believe that? And that was the time that people were so excited the war was over. They wanted to have fun and go out and drink, and that was when the prohibition came on and they weren't allowed to drink, but they did anyway. The jazz age, Louis Armstrong, famous jazz. Oh yeah, and the ladies wore flapper dresses. They were very high. The hemlines were up.
Those socks.
Yes, yes. And if you look at the market goes up, bull markets take a staircase up. And by the way, there was an old mentor of mine, Ralph Rottenham, who created the hemline indicator. When the ladies' dresses go up, the market goes up. And you'll see what happens a little later. When the market goes down, ladies' dresses go down. And this is Lauren Bacall and Humphrey Bogart. By the way, this little recession here was only 6 months. It was in 1927. Within that long-term bull market, we had a minor recession. That was because Henry Ford switched from the Model T to the Model A. And that car was very popular. It was the people's car. You can see that picture there. And everybody had to have a new car. They wanted a new car. They wanted to go out and have fun. The war was over, and and they started speculating like crazy in the stock market. And that's when they had margin, and people didn't know anything about margin. They took advantage of it, and they overdid it. I got to tell you something. President Hoover comes in, and about 9 months later, the crash starts. Look at this. And as a president, they blamed him for causing that, and he was only in office a few months. I feel sorry for the guy.
Yeah.
Yeah. And here is
Biggest crash.
yeah, well, staircase up, the elevator down. Bear markets come down like an elevator. Look at that. Yeah. Look at that counter trend rally we had. We dropped 49% and a kickback rally of 52%, and then it just faded again. Dow was down over 9%. That's the worst decline in the stock market's history, in the Dow Jones history, 89.4%. That's from 1929 to 1932. And of course, Franklin Delano Roosevelt became president, and he signed the New Deal, and that started getting people back to feeling better about things, but it still took a long time. And as far as I'm concerned, the Depression lasted 10 years, from 1929 to 1939. And there's a debate as to what made it end, and it wasn't the New Deal necessarily, this is my opinion, but it was the war, the Second World War, that put everybody back to work, and that ended actually ended the Great Depression. You can see here, I have, look at this, the Nazi Party. Look at this, Hitler in Germany, 1933. He started to become very powerful in Germany early on, years before the war started. And you can see that we had a nice recovery for a while, and then the war starts. There's an old adage, look at this, buy on the sound of warring cannons. In other words, when war starts, the market goes up. It sounds almost kind of intuitive, but got to start spending money, hiring people, putting them to work and all. And they say, the famous quote is, sell on the sound of trumpets of victory. That was Nathan Rothschild's quote, famous quote.
Mm-hmm.
Yep.
So let me go back on these two. What was the Fed's position when this happened?
The Fed's position. That's a great story. There's a big debate between Maynard Keynes and the economist, and Milton Friedman, the economist. What happened that the Federal Reserve made a big mistake. Instead of giving money to the system, putting money in the system, they tightened up the system. They were holding back. They tapered, yes. And they didn't put money into the system. And in hindsight, they realized that was a big mistake, and the recession stayed that long, 10 years. And
It's completely opposite what's going on right now.
yes, exactly right. Yes, exactly right. Perfect example. Just pour it right in there. And that stops banks from collapsing, and people have run on banks and things like that. Yeah. So you can see here the reaction. Look at this. War started, at least in the United States, in 1941, Pearl Harbor. And the first leg up is 130% by 1946. But guess what? Sounds of victory. And the market pulls back, drops. Because people are going to get on. Look at what happens after the war in the 50s and 60s. The market goes up. Why? Because people want to go out and buy houses. And that's when President Eisenhower started building highways. Well, that was a big introduction in the United States. Biggest ever at that time. And the market loved it. And people went out and bought new cars in the 50s and 60s. Those were the best cars. The cars today all look the same. But in the 50s, that was my era. I loved the cars. Anyway, not to get too old. And this is Eisenhower, and of course there's President Kennedy. And you can see that gold started rising in that period of time. It didn't stay at $20. It started to go up to around 35. It was very volatile in that period of time. You know, the market went up, and it got very close to 1,000. Actually, it was the first time it got to 1,000 was right there, 1966. And then 1966, and then we had a sharp decline of 26%. And that's when I walked into the market. I came into the market in 1967, and I couldn't believe everybody that I saw and met had these long faces that were so depressed.
What year was this? 1966 when you started everything.
Yeah, 66 and 67. Yep, that's when I came in. Here it is. I started on Wall Street. Yep.
What you can remember from that day? What you can from this particular year? What did you have in mind?
Well, when I first came into the business, my job was to plot prices. I was the computer to keep the graphs of all the stocks and all the indicators. And that's how I fell in love with technical analysis, because I had no economic background. I was a history and political science major in college. And when I got to Wall Street, it was like, wow, this is different. This is fun. This is exciting. And, you know, doing it by hand in the old days is still the best way to do it, because you have a feel for the market. And it was there that the man that ran the company actually was a small mutual fund called Distributors Group, and the man that started the company was Harold X. Greeter. Harold was an economic advisor to President Eisenhower. And he and I became very good friends. He said, well, I'm going to send you to school. And he sent me to the New York Institute of Finance to learn about finance and, you know, get back into it. And it was there that I met a wonderful guy by the name of Alan Shaw. He was one of the primary technical analysts in the street, and Alan hired me from class. So I left Harold in 1970, in 1970, and I joined Alan, and that huge impact on my life.
Wow.
Yeah, so all of this. Oh, by the way, if you'll notice that the Dow for the next 15 years can't do anything but trades. It couldn't get above major resistance at 1,000. It did it only for a short period of time in 1973, but it only lasted about a week. And then we had my first real major decline. Look at this. It was down 45%, the Dow. That was the Arab oil crisis. In fact, this is my quote. I'm very proud of this quote. The bigger the top, the bigger the drop. Bigger the market top, the bigger the market drop.
Tell me, Ralph, about these
stars.
Yes.
Well, those are the young people that were born at the time. And
Who is this guy?
that's a guy that you know. His name is Jay Woods. He's on the floor of the stock exchange. He was born in 1971. Yeah.
He's your signature here
Yes.
on Bluff Farm, right there.
Yeah. Yes. And those are his sisters and brothers that were born right after him. And by the way, you're starting to see interest rates. See the orange bar? That's the high-low for the Fed funds. And you could see the Fed funds in the 70s started getting higher and higher. It wasn't until into the 80s, early 80s, that we had record rates. Here, you can see here, interest rates. It's on the wall somewhere. Here, record prime rate, 21.5%. Here it is.
Let me tell you this. How much will you pay for a mortgage?
Oh boy.
This
Oh my
particular
gosh.
year in 1980. This is the year when I was born.
That was the year you were born. I got to put your star up there. Got to get a star. One. Okay.
It will be an honor.
Yeah. So that's the record in interest rates. And as we go along the wall here, you'll see that interest rates slowly were down over time. And that was because of Ronald Reagan, the president, and what he did. Yeah. And by the way, because
so the market was choppy.
Choppy, oh yeah, and then it took off. That was the beginning of the great secular bull market.
And the rates started going down.
Yes. Yep.
When they were in 1980, if I'm not wrong, is when the inflation hit.
Sure. That's the stagflation. Look at where silver is and look at where gold is, the record levels. Yeah. Good for you. That's the stagflation period. Yep. And of course, this horrific decline here is the famous 1987 crash. Yep. Dow dropped 36% in a couple of months. Boom. See? Then I had to rescale the chart. I started down here because we had the major secular bull market continued from 2000. That was the low down in that area.
1 second, let me get you this. For the new traders, explain today what is a secular bull market.
Good. Okay. Well, we all know what a bull market is when stock prices go up. A cyclical, with a C, spelled cyclical, bear market means that advance could last 6 months, 8 months. You measure it in months. A secular bull market, spelled with an S, means a bull market that could last years. So it's a long-term advance. And that was the beginning of the long-term advance that you could see on the wall. See, look at interest rates coming down, and there's President Clinton. He becomes president. What else can we talk?
Yeah?
Yep.
Clinton first.
Oh, I had to put this on the wall. That's when I wrote my Dow 7000 report. The Dow was around 4,000.
Tell me more about what happened in these particular months. Tell the audience what happened.
Yeah. Well, one of the oldest technical analysts I ever met was a man by the name of Ken Ward. He was a very famous technical analyst for many, many years. When I met him in 1970, back there, he was 80 years old. And I asked him, I said, Mr. Ward, what was the most difficult market you ever had to deal with? Then I said to him, I'm sorry, Mr. Ward, it had to be the crash of 1929. And with a grovelly voice, he said to me, no, young man, that wasn't the toughest market for me, for us technicians. The toughest market was in the early 60s. I said, but it went up. He said, yes, and no one believed it. It kept climbing and climbing and climbing. Well, I never forgot what he said. And by the way, we were going from 2,000 over here to 4,000, and I never forgot the story. So I went back for this research report. That's the title of the report, Dow 70. I went back to the New York Public Library and I read every Wall Street Journal from 1960 to 1966. I wanted to find out what he was talking about. And you know what was common now at that period of time with the early 60s? Low inflation, low interest rates. That's the fertile ground that secular bull markets grow in. And that was my report. I was very, you can call it luck, I call it research. A couple of years later, we hit 7,000. And then everybody told me, all right, Ralph, shut up. You did enough. I said, no, I think it's going to go higher. And I raised it to 10,000. And guess what? We got there. Those are my best calls. I won't talk about my bad calls, of course. Yes. So we got up to 10,000, and we went sideways for a while. And then we had our 2001 decline. This was 9/11 over here. And we recovered, and we went back down.
I'm gonna just right here, I'm gonna point out something that I know is special. Family is very important to you, right?
Oh, absolutely.
What represents this investment to you? Tell the youngest generations.
Listen,
what does this represent?
the most important investment you'll ever make in your life is the person that you will live with, you will have a family with, you will grow with, and you will love. It's your wife. And Rosemary came into my life. She was a stockbroker. In fact, she was one of the first stockbrokers in Minnesota at the time. And I was in New York, and we met, and we had a commuting marriage for a while. And then I just brought everybody to New York, and then over the years they brought me back out here. And it's been wonderful. It's still wonderful. I can't wait. She's going to be coming over in a few minutes and ride her horse. And Ron and I are going to, and we're going to watch her run away. Okay.
Right. Let's keep going.
Okay.
Nice.
Oh, no.
Now, let me point this. For the people, they're taking the CMT level 1. Tell everyone what represent in 2004, because it was an important achievement that you were involved. Just tell everyone what was that.
Oh, well, thanks for bringing that up. Market Technicians Association meets with the Securities Exchange Commission. A couple of years before that, well, a year before that, the Sarbanes-Oxley law came out in 1980. Came out in 2004. Sarbanes-Oxley law came out. And it said that all analysts, and I was an analyst, had to take 2 new tests, Series 86 and 87, which was levels 1 and 2 of the CFA. I stood up, I said, wait a second, I'm not a fundamental analyst. I'm a technical analyst. And yes, I want to be, we should be tested, but we should be tested on our body of knowledge. Well, myself, David Krell, wonderful guy, past president of the organization, Barry Sine, and Ken Tower. Also, Ken was also a past president of the organization. We stood in front of about 10 SEC lawyers, and we brought our case to them. And I had the last commentary to make, and I'm standing up in front of these lawyers and I'm saying, imagine if you lawyers were being mandated tomorrow to take the medical boards. They looked at me like I was crazy. I said, assuming you could pass the medical boards, you wouldn't use that body of knowledge in your daily work as lawyers. And they said, of course not. I said, well, that's what you're asking us to do. I said, please test us on our body of knowledge. And with that, one lawyer jumps up at me and he says, oh, Ralph, we know you. We see you on television. You're a nice guy. He puts a chart in my face. And I got to tell you, I was really nervous. He was asking me a question. And he said, what's fact on this chart? And I looked at the chart, and I stared at him. I said, price is a fact. His eyes got about this big, and I went like this with my finger on his chest. And I said, earnings are an estimate. You restate earnings, you never restate this chart. He said, darn, that's the best answer I ever heard. I said, you better believe it. And we walked away. 3 months later, the SEC comes out and accepts the certification, the technical CMT exam, the Chartered Market Technicians exam, is equal to the CFA program, which is important to the fundamental analyst. That to me is probably the proudest day in my working career in the industry. And I look back, and now I look forward, and I see all the people around the world taking this exam. I am so happy that they're doing it, because you're not going to learn it in school. And here we have the subject, and it's been blessed by the Securities Exchange Commission. So go get it. If you're young, you have to get it. I promise you, it'll make your job a little bit easier, because you have a different set of glasses on, and you're going to be looking at what the market does on a supply and demand basis, and that's key. How am I doing?
Yep, all good.
All right. Oh yes.
Now, this is important
Yes.
fact, this subprime
Yep.
crisis.
Subprime.
What do you
Subprime.
remember?
Well, 2007. I retired from Wall Street. It only lasted 2 weeks, but my retirement. But I was asked to be on CNBC. They wanted me one more time before I retired. And Mark Haynes was the announcer. He said, "Ralph, we're going to miss you." I said, "That's all right, Mark. I've had enough bull and bear markets in my lifetime." He said, "Before you leave, Ralph, tell us, what do you think of the stock market?" This is September 2007. I said, "Mark, there's something called subprime, and I don't really understand it. But my biggest fear is that I don't think anybody else understands it." How profound that statement was, because no one really knew. And a couple of months later, it started to take its fall, and it created the second worst Dow decline. I showed you the first one in 1929 to 1932 was 89.4%. This is 54.4%. And I thought the worst was the Arab oil crisis that I saw, but no, this is the beauty that's falling apart. But notice, Barack Obama reminds me of Franklin Delano Roosevelt. Roosevelt came at the bottom of that bear market in 1929. And Barack Obama came at the bottom of this second worst decline in Dow's history. Good for him. And the market had one of the greatest runs in quite some time.
Wow.
Look at this. Look at that. From 6,469 to over 24,000. Before we had any real sell-off of any consequence. And by the way, at this period of time, the Wall Street Journal came. They wanted to do an article on my chart. And I said, wait, when the Dow goes through 23,000, you can say the market went through the roof. And they did. Isn't that cool?
Yeah, now it goes back, Ralph. Okay,
Yeah, now that's...
Tell me something, because
Yes.
you know, I'm very proud of you,
Oh,
what you
yeah.
had done.
Thank you.
But this one is a special moment here. Your 50th anniversary.
Yes.
So, what you can tell us? How do you feel after 50 years
Yes.
in this long journey?
Yes.
How do you feel in this particular moment? That
Well-
was in 2016.
16, 17.
Just tell us more.
Well, I have all the indications on this chart of what the lines are, and I explained the lines to you. And we had 10 presidents in my 50 years. And you know what, I purposely put their middle names in there, like James Earl Carter. Does anyone remember? Earl is his middle name. Ronald Wilson Reagan. I don't think many people remember. Anyway, I did that as... and here are the 7 recessions in my 50 years. But I ended by, look at this. The Dow's 50-year opening. When I started in the business, the Dow was around 700, give or take a few points. When I ended, it was at 24,000. So in my 50 years, the Dow is up over 3,000%. So I say to everyone, it pays to be an optimist. And That's why everybody said, oh, Ralph's always bullish. Yes, not really, but I try to be an optimist.
All right, cut this part.